Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Welcome back, everyone. We're excited to have you this week. It's been a little bit, although our guest today is someone that we know and are extremely excited to have on our episode. Jason, who do we have coming on?
Today we have Kim Butler, and I am so honored that she'd be on our show. Kim is someone that I highly respect and look up to. She's someone that I have known for a while. And, anytime I'm around her, I learn something. Anytime I'm around her, I'm amazed by how much of a giving individual she is. She's truly cares about people and is so free with her time and her knowledge and everything. To give you a little bit of background on Kim, she at one time was a certified financial planner, and we'll talk a little bit about that, why she doesn't have any more. She's published 8 books. She's the co-founder of what's called the Prosperity Economics Movement. And at one time, she worked with Sharon Lechter and Robert Kiyosaki and that crowd, and still has ties to them. Super individual. And for those that may or may not know, we had a guest a few weeks ago, Todd Langford. Both Todd and Kim are husband and wife. So welcome to the show, Kim.
Well, thank you both. Always a joy to be able to talk with like-minded individuals.
Like-minded. I love that. That may have not always been the case since, tell us how you started in your career and why you decided to go out and become a certified financial planner. Why was that important in things?
Great question. So about 30 years ago, I left the banking industry and got into what is generally called the personal financial services industry. And the normal route in there is a whole bunch of licenses. So I got my life insurance license, disability, the series 6 and 65 and 7, and all of the arena around investments. And a fairly logical next step is to start then on designations. So for consumers that might not know, licenses give you the ability to sell a product in most cases. Designations, in theory, give you some additional education to do a better job around the sale of that product, installing that product in people's finances, in this case, et cetera. Is that a good setup so far?
Yes,
you have a sub question?
I love it.
Okay. So I got my CFP fairly quickly. That's a 2-year program. There's amazing education that occurs during that time. It's literally like getting a master's degree. And then over a period of 3 or 4 years, so at this point, I'm about 5 years into the business, I started feeling really out of sorts with what I knew from my studies that I had learned from the CFP program and what I was seeing happen in the lives of my own finances and the lives of my clients. Now, you got to remember, this is 1990 to 1995. So we don't have the internet. We have HP 12Cs to get future value calculators and things like that. And people were not as in tune with their finances, really, as I think we are today, which is a good thing that we are more in tune today. Nevertheless, every time I handed somebody what is typically called a financial plan, I had a horrible pit in my stomach because I was very clear that the computer, which, this is like the big thing in the back. I don't even know if we had laptops then, that you crunched all these numbers on, had made a bunch of assumptions. And we all know what the word assume looks like when we spell it out. And I was not comfortable with that. Here I'm handing somebody a document. It's beautiful. It has all these assumptions in it. And while mathematically correct, it had nothing to do with their lives. I was not okay with that.
So theory did not match up with reality. And I think it's kind of rare that someone dealt with that. I mean, to some degree, you you needed to live. You still had rent, you still had food, you still maybe had a car payment. I don't know. You had expenses. And sometimes maybe the focus on those expenses can overshadow in someone's mind this cognitive dissonance, I guess you were experiencing, something
Perfect
like that.
word. Yep. Yep.
So how is it then you started to say, okay, I don't feel comfortable with that? Did you start searching for something? Did you just think about getting out of the industry? What was your next step forward?
Well, I'm going to back up one step first, and that is something that is integral to the work that we all do. And that is because I had savings, I was able to do what I'll tell you about here in a minute. And so I had, in the first 5 years, learned how to save and how important liquid money was, not retirement savings, not anything in real estate, not any fancy investments, boring liquid savings. And because of that, I was able to step back a little bit. I had enough savings that I knew I could go about 6 months without having to produce new all the time. And it enabled me to step back and start to do research. And again, this is around 94 now, so we really don't have the internet yet. So that meant asking people, right? And I went back to a lot of my banking clientele. When I was first out of college, I worked for 3 years at a bank. Many of them were entrepreneurs. They were real estate investors. They were people that had handled their money well. It was evident at the bank, so I knew enough about their finances to know that. And I just started asking questions. What have you done? How have you done it? What programs did you follow? Do you have a financial plan? The answer was usually no. Can I look more thoroughly at what you've done? And I just talked with people, and then I would ask for a referral. Like, I don't want to sell anything. I just want to keep learning. And so I kept learning and I kept asking. And over a period of time, I narrowed it down to the good results that people were getting with their personal finances came into about 3 main categories. Before I go there, questions?
I don't. I mean, well, yeah, real quick. You said that you had saved. What was it about you that saved? Is that something that we were brought up with? I mean, my parents were teenagers in the Depression. Okay. And so it was beat into my head about savings. You save, you save. A portion that you make, you save always. So I've always had a nice savings account, even as my earliest recollections, whether it's pouring concrete at the mobile home park or delivering the newspaper, right? When I was paid, there was a certain amount that went over to Idaho Bank and Trust, which is just a block away from my house. And I put it there. And I had my little savings book, and it was always fun to open it up and show people I have this amount of money. Did you have something like that? Were you a saver?
Well, as many people know, but maybe not your community, my dad and mom got me a milk cow when I was in 4th grade. And so I milked the cow and sold the milk and had money as a 4th grader that some adults do not have today. And over my entire childhood, my sister got involved as well. We milked cows, sold milk. We drove combines, got paid for that. Your concrete work was our tractor work. And hauled hay and did all the things that come with farming. We lived on a farm. My parents were teachers, so the farm was kind of part-time, which means the girls did all the work. So that did start me out as a young adult with some savings, which is very unusual and a habit. And my parents were very, very frugal with their money, and I think drove some of that savings behavior. But in addition to that, during the 3 years at the bank and now 4 to 5 years in helping people with their personal finances, I saw it every day. I saw people that could live their lives with peace because they had savings. And I saw people that were under extreme duress because they did not have savings. And so that drove behavior because I was faced with it every single day. It's a great question.
All right. So I want to make sure put a fine point on this. You actually step away from your personal financial services. I mean, you stepped away from that job. Is that correct, to start to do this research?
So I did not step away. I just slowed down and added in more research time and a little less sales time.
Okay. So now come back to where you wanted to go.
Sure. So the research kind of gave me a sense of about three things that people were doing. And it was some entrepreneurial endeavor, some type of real estate, investment oriented real estate, and whole life insurance. And I had not learned about life insurance. I didn't know about life insurance. I had absolutely no background with it prior to when I started. And this was 3 to 4 years before this. So I'm out in the community helping people buy life insurance, but I hadn't really grasped the value that it could provide. And I did not understand the difference between universal life insurance and whole life insurance. And doing these, call them informational interviews with all these reasonably wealthy, not super high end, but reasonably wealthy people, and seeing, again, real estate, entrepreneurial environments, and whole life insurance really helped me understand the difference and see the value of how whole life insurance fit amongst the entrepreneurial community and the real estate investment environments that most of them had.
So, Kim, I don't want to shoot the gun here for a second, but I have a lot of conversations about this particular subject. In particular, I've got one or two people in mind who like to debate the difference between whole life and universal life. And while I know quite a bit, I don't know how to explain that. So can you give me the differences and help me understand better on why you would want to do one versus the other?
What's he saying, Kim, is his dad hasn't explained it well enough, or he may not believe me. He wants to hear it from a different expert.
Love it.
Just to be clear here, okay?
Well, it's something that took me years to get the clarity on, and probably another decade to be able to explain well. And I believe that I've landed on an analogy, which of course analogies help us learn. And sometimes analogies can only go so far. Like at some point you have to abandon the analogy because it's not accurate anymore. But this analogy I have found drives these points home the entire way, and it's correct and thorough throughout. And you'll get it immediately. And it is this: whole life is like a brick and mortar home built on a cement foundation with a metal roof. Brick and mortar home, cement foundation, metal roof. Universal life is like a mobile home or a trailer home that is not on a foundation and does not have a metal roof. And it can even go one step further. If you happen to find universal life that has a guaranteed death benefit rider, then it's still a mobile home. It just has one of those metal building roofs put over it. Have you ever seen that, where the mobile home has its own roof and then that roof was failing, so it was easier just to slap a metal roof like on a building on top of it, just the roof part, not the sides. So universal life, mobile home, whole life, brick and mortar home, foundation, metal roof. Do we need to go further? I'm happy to.
It would be helpful because I have two people in mind that are going to need more specific than that.
Sure. Let me ask Jason, though, from your knowledge, does that land?
Yes, it's a good analogy.
All right. So let's keep going. So universal life, and it doesn't matter whether it's index universal, variable universal, fixed universal, zebra universal, Apple universal, and everything in between, A and Z, right, is still universal life. And it also doesn't matter whether it has a guaranteed death benefit rider on it or not. It is still universal life. And just like a mobile home, it will not withstand a storm. It could, but it doesn't tend to. It is absolutely not for lifetime. And again, it could be, but it doesn't tend to. And have you ever tried to buy like a replacement sink faucet for a mobile home?
I have.
So Todd and I lived in a mobile home for 3 years while we built our home. And when things fall apart in your mobile home, you go to Lowe's, you don't get to buy the Delta faucet that's, $100 or whatever for a nice quality faucet. You have to buy a mobile home faucet, which is probably not made by Delta, probably costs $120 and is literally made to fall apart in a short period of time, like 10 years, whereas a Delta faucet in a regular home could last a lifetime, right? So just like universal life, everything in a mobile home is suspect and is not there for pure longevity. Whereas with whole life, you have potentially a higher cost because brick and mortar, a cement foundation, a metal roof, these things all cost more because they last longer and there is more value to them. And so these two spaces, while in the short term are not a lot different, right? Both build cash value, both have a death benefit. If death occurs, they will pay. Like there's absolutely not a lot of difference in the short term. But in the long term, there's massive amounts of difference. If you took a brick and mortar home and ignored it for 50 years, it would still be there in decent shape. You took a mobile home and ignored it for 50 years, it would be crumbling. I live in East Texas. We have a few of those. They're sad. And so it took me a while to realize this distinction. And Scott, let me just throw a couple more sentences out and then I'll come back to you for questions. The biggest impact, I think, that helped me learn the nuances of universal life. And you'll hear people say, oh, it's almost like whole life. Well, a mobile home is a home, but is it a house? So universal life has some of those inherent problems that a mobile home does when you try to look at it from a longevity standpoint and also from a guaranteed and absolutely positively going to be there standpoint. And here's how it was proven. I got a call from some people that were not clients of mine. They had been referred for help because 20 years prior, somebody had sold them a universal life. It was minimally funded, just straight regular universal life, minimally funded. And now I think they were in their 70s. The insurance company was requiring more premiums for the universal life policy death benefit to still be in place. And there was very, very little cash value. That woke me up. These people were devastated. The gentleman was ill. Money was super tight. There was no way they could pay that extra premium. The cash value was not going to sustain it. They lost their insurance. He passed on about a year later. That rocks you to the core when you see something like that happen. And then there were just a few other things, one of them being Todd Langford's Truth Concepts software that helped me really, truly understand whole life with all of the flashlights shining in the black box that sometimes whole life can be, for me to get crystal clear that with 99.9% of the time and 99.9% of the accuracy, I will only work with whole life plus term insurance up to a human life value standpoint, which we can talk about here in a minute. And I will not work with universal life. I don't want to be associated with it in any form or fashion. There is that 0.01 odd environment. For example, I have somebody that's got some really serious medical issues. We couldn't get them approved for whole life or term. They did find a universal life. I had them overfund it. It's the only thing that we could do. That's literally about the only one that I can think of. Otherwise, I don't want to touch it. I don't want to be involved with it in any way. I will walk away.
Okay. So I got one more question. We can move on.
Okay.
So every time I bring these up to these two people I'm thinking about, and I'm not going to call them out, but they're going to know exactly who I'm talking about.
Your age, am I assuming, Scott? Someone that's
Kind of
late 20s?
One's a little bit younger and one's a little bit older, and you know the one older.
Okay.
They always bring up, if I overfund it, it's going to outperform. I've seen the numbers. It outperforms because I'm not going to get a zero basis. Like, I'm not going to lose money, but I'm going to get the stock market return, which everyone says on average goes up by 8%. Now, I've always gone into, like, I understand a lot about options. I trade options. I understand all of that. But if we were to keep it basic, how would you explain the difference, and why in the world, like, what's the rebuttal to that is what I'm getting at.
Sure. So there's a point of fact that is incorrect first that must be addressed. And that is that when the account earns zero, you will lose money, because when the account earns zero, there are still insurance costs, option trading costs, administrative costs that are going to pull that account negative, usually about 2 points. So you will lose money. It's not that you cannot lose money. That is completely inaccurate. So that point of fact being made clear, the next issue is that the underlying structure, and you often hear the word chassis, okay? Like, I didn't even know what a chassis was, but it's the thing that a car is built on. The underlying structure of universal life, doesn't matter whether it's index universal or any of the other cousins, is term insurance. And term insurance has an annually increasing cost. And so inside any kind of universal life, you have a growing cost that will occur year by year by year by year by year. And so there is absolutely a chance that amazing stock market returns could grow the cash value so fast and so big to overcome for a lifetime those rising term insurance costs that are a natural inherent part of universal life. There is absolutely a chance that that could happen. But you and I both know that there's also a chance that the opposite could occur, which would mean they would have no cash value and no death benefit, because there would not be enough money to pay that rising term insurance cost. And with index universal life, there's actually a column that says cost of insurance, and you can see that rising cost. So I'm not saying that it might not work out. Like, it could be beautiful, and I want nothing to do with it, because, as we all know, death is a guaranteed event. And I only want something attached to that event that is absolutely positively going to be there. And just real quick, of course, the internal costs of whole life rise as well, but they're on a guaranteed basis and they're built in, and the premium is higher to overcome that. And then just one last thing, I will not let people talk about, and I used to do this, and I've switched my language and learned, I will not let people talk about whole life insurance as an investment. It's not. It's a savings equivalent. If you want to go invest in options, please do that. Do the S&P 500, do investment real estate, do the litany of investments that are out there. Have at it. But your emergency / opportunity money should be stored in a safe place that is absolutely positively going to be there.
Perfect. Thank you for that.
You're welcome.
I'm going to add there, Kim, that I've been doing this little over 17 years now. And whenever I have had someone that comes along and says, oh yeah, I have, a UL, a ZUL or a Zebra. I love that Zebra UL or Apple UL. I say, great, let's take a look at it. And in the whole time that I have been doing this, I have yet to have someone present me with an in-force illustration that shows it continuing on. Every single one will collapse. I don't know, whether they've overfunded it or they've underfunded it or whatever. And I don't know what's been your experience. I guess I can eventually find someone that it will show that it will go on. Yet I have not had that experience yet. So I'm open to seeing that. And I always often share that with people as well. So let's switch gears a little bit. And you say, well, go have at it and invest and do all these things. At what point do you think people should be looking to invest? Is it some of their first money, or is it later money?
So this goes back to the story that you and I have shared, which is the unbelievable value of liquid savings that are not invested and not in a retirement account. And so I believe that people need to define for themselves what their emergency fund is. You know, for a young 22-year-old kid, maybe it's 10 grand. Awesome. Build that and then invest. For a lot of families, it's 100 grand. For Oprah Winfrey, she's publicly stated it's $7 million, right? I mean, emergency is all relative. Cash flow issues don't go away. They just get bigger zeros on them. And so the family absolutely wants to define their emergency fund number and put that into whole life as a savings vehicle. And then I believe that people should also build an opportunity fund. So if you look at some of the really fun investments, which are typically for accredited investors only, and they have minimums of 100,000 or 250,000 or even $1 million, they literally require that the person have a certain amount of money liquid. And the most common number that I've seen is about 150 grand. So if you have a $100,000 emergency fund and then you want to have a $150,000 opportunity fund, so that you can get into the super cool investments, then you're going to want to have a place to store that cash. And the mutual life insurance industry is the best place to store that cash for all the reasons that you talk about. And so that emergency opportunity environment is what I encourage people to think of before they invest.
Your husband Todd had said that whole life insurance, having whole life insurance and having that cash value makes all other investments better. All over, and it should make, he didn't say that, but I thought it sense it should make all over investments possible. All other investments should be impossible until you've done exactly what you've said. You've built up your emergency fund, and then you have an opportunity fund. Now, let's be clear, and I'm pretty sure you're saying that those don't need to be two separate funds. However, it can be in one fund, one whole life insurance policy, the cash value. You simply, annotate it in your personal balance sheet or how you do that. This amount is my emergency fund, and this amount is my opportunity fund. And I will use the opportunity fund money to invest, but never go below my emergency. Right? That still needs to be there always. Yep. What are some examples that you know of that where people have used or been in a position, since they do have rock solid whole life from a mutual company, that they've been able to take advantage of some opportunities?
So I do want to back up one sentence, and that is, you're right. Emergency money and opportunity money can all be in one policy, and it should probably be in 10 or 20 policies. Like, people need to understand that there is a value in building a portfolio of policies, just like there's a value in building portfolio of stocks, portfolio of investment real estate, et cetera. And so if you're going to do especially alternative investments that requires accreditation, having that $100,000 emergency fund, that $150,000, I can do my accredited investor monies, and additional opportunity dollars, like, that's probably going to take more than one policy, and beautiful, more power to you. So
let's talk just real quick before you go on. You think there should be multiple policies, multiple pockets of money, and I get that question a lot. Well, should I make one great big one, or should I put my toe in the water? Well, how do I do this? How do you're saying it should be 10 or 20 different policies?
Sure. Created over a lifetime. So I started buying life insurance when I was 24. And then every time my income went up, I bought some more. And sometimes it was painful. Like, I would come back from attending one of Todd Langford's trainings going, dang it, I know I need to buy another policy. I know I need to commit more premium. I don't want to any more than our clients want to, but I'm going to do it. And over time, it served me well. And so, yes, people now, if they're just starting with you and they're, maybe in their 50s and they have tons of capability, it's going to make more sense that they buy a larger policy, but they should have one on themselves. They should have one on their spouse. They should have one on adult children. They should have one on grandchildren, in that order, right? Oldest generation
Wait,
first.
wait. Say that order one more time.
One on themselves and their spouse, right? That generation. One on their adult children, the next generation, and then one on each of their grandchildren.
Okay, hold on a second. Jason, I got it twice and on recording. So which is it?
Okay, well, I differ with her a little bit. I say it should be on themselves and their spouse, and then depending on the age of their parents, I believe that they should insure their parents and get policies on them, and then start working on their kids.
Yeah,
and you're using adult children and then grandchildren, and I have both, right? And yet, like my 14-year-old, her policy is, I think, 12, 13 years old. The suitors that come around, and she's beautiful, by the way. Suitors come around, they're not going to know about it. She has a very, very healthy policy. So talk about that. I mean, is that really your question, Scott? What are you trying to say? You're arguing with me here.
I'm not trying to argue with you. I'm trying to nail down some of this, because a lot of what we're talking about, Kim, is the conversations behind the scenes between Jason and I.
I love
it. Because I make very good income, and we have always gone back and forth. Well, do we do a policy where I know I'll be able to do that forever, or do we do something where I can do as much as I possibly can for the next 7 years, and then it drops, but then I have to open a new one? Where we've gone back and forth. We've gone back and forth on, well, do I have a daughter come in December 16th? And my wife and I have finally maxed ourselves out as far as we can go, we've maxed ourselves out. And so that next step has been a debate as well. It's like, okay, well, do I do it on my daughter coming? Do I let my parents do it? Are my parents going to do it? Do I do it on my in-laws? Where do I go from there? So that gives you some context.
Absolutely. So let me address the fourth space. So 50-year-olds, 30-year-olds, 10-year-olds, whatever. That 70-year-old, absolutely. That direction could go either way. I was going to bring it up as well. I absolutely have 50-year-olds buy it on their 70-year-old parents. And yet, as we know, there is not an unlimited amount of money for most families. Often people that are older do have health issues, et cetera. But I've actually done some research when I've dealt with a 4-generation space, like what we're talking about. And I can quote these numbers specifically only because of Todd Langford's Truth Concept software. I did some research on very similar policy structures for the 4 generations, and the internal rate of return on the cash value varied from the 70-year-olds down to the 10-year-olds by 6 basis points. In other words, not a full percent, but 0.6%. So the younger was in the 4.5 range and the older was in the 3.9 range. So as you all know, but as our communities do not know, there is not a massive improvement by being able to buy life insurance on a 10-year-old. Plus, you've got limitations in terms of the human life value that you can place on a 10-year-old. So I'll come back to Scott's family's question in a minute, but it's perfectly acceptable to go either direction. It's going to depend on money, longevity. We do own insurance on some of our parents. So we're in the 50s. We own insurance on people that are 70s and 80s. I absolutely own insurance on my adult children who are in their 20s. It was purchased when they were 1 and 2, and again when they were 6 and 7. And then, Scott, I'm going to give you a story to answer your question. My son, who's 26, bought insurance the day he turned 18. He happened to be in Texas in our home. He had been away at school, and he got his physical exam, signed the paperwork the day he turned 18. So that's the first time you can sign a legal document, right? And he used that policy as his emergency fund as he went through college. Now, he had some really good summer jobs. I don't know that every child would be able to pull that off. And it was a small policy, but he used that policy during his college. As soon as he got his out of college day job, he bought his second policy. A couple years later, he came and he was ready to buy his third. He wanted to buy a very large base premium only. Now, we had the little tiny paid up edition rider on there to open the door, but he wasn't going to do the often structured max cash value minimum death benefit environment, because he knew, because he'd been listening to his mother, who's worked from home for a long, long time, talk to people about these life insurance policies. He knew the value of getting as large of a policy as possible at the base premium. It was enough to choke a horse. I said to him, are you sure? This is a really big step. It's a really big, big step in a big way. Are you sure? And he was totally dedicated to it. That policy has served him so well I think he was about 24 when he did that.
And he's the insured, to be clear, he's the insured?
Yep, he's the owner and the insured.
Okay.
Yep. And he does not have children. That policy has served him well. It has been an extreme challenge. It has forced him to be creative, because at some point he did quit his day job and get into investment real estate full time. And so he had uneven cash flow, and it's forced him to be creative about how to pay the premium, how to use the loans, how not to use the loans, how to involve the whole life insurance with investment real estate, which is like the best combination in the world. And it's been a really fun process to watch. And he's handled it all on his own. My daughter bought her own policy, her first one, when she was 23, I think. She took a little bit longer. She didn't have good summertime jobs. And she, out of college, wasn't quite as ready to take the step. So fine. We'll have our first grandbaby in October. And so it will be an interesting discussion, who gets to buy the insurance on that grandbaby. That family has a really, really good income. So I may just let them go do it all on their own. But it's absolutely a very personal decision based on the family. And the last thing that I'll say about it, and Scott, if you have specific questions, I'm happy to dig in a little bit further, is that it is very important to me, and this brings our human life value sentence back to our current conversation, that people have whole life plus term insurance to equal human life value. And I've even come up with an extremely corny rhyme to help us remember it. And it's WL plus T equals HLV. Whole life plus term equals human life value. WL plus T equals HLV. And the reason that that's so important is because there's so much conversation out there about, do I buy whole life insurance or do I buy term insurance? And the answer is you should absolutely buy both. And then there is like no discussion of human life value. Thank you, Michael Isom, for getting his book out there. You know, we're going to make human life value the common term that it used to be in the 40s and the 50s and even the 60s, before mutual funds, 401ks, and E.F. Hutton came around, which was the start of universal life. So this is a very fun full circle for me to see as we progress in this arena. And I know for myself, I just rebranded for another 30 years because I love what I do. And I know what retirement does to people, and I want none of that.
Cool. Hey, I wanted to come back. You said the best combination ever was using whole life insurance and real estate investing. Did I hear that correctly?
That's correct.
Why do you feel that way?
Because the death benefit. So all of our conversation to date has been about the cash value. And that's what everybody's interested in, and borrowing against the cash value to take advantage of opportunities, right? Whether it's real estate investment or any other thing. And the presence of the death benefit opens up real estate transactions in our later years, typically in the form of charitable remainder trusts, that enable us to have the permission to spend down, utilize, if you will, all of the other assets that we have, the investment real estate, the stocks, bonds, mutual funds, the retirement accounts, et cetera, et cetera, et cetera. I'll say it again. The presence of the death benefit enables us to utilize all those other assets and is extremely valuable when combined with investment real estate to reduce tax, increase income, provide additional stability. And that's why those two products who act very similarly, if you look at how real estate acts, the way that you can borrow against it, the tax benefits that you get, and you look at whole life insurance and how it acts and the way that you can borrow against it and the tax benefits, and then you look at the death benefit and the ultimate value of investment real estate, and having those two things come together at a very specific point in time, that is why I make that statement.
I love the way you think. Is it the way you think and Todd's learned from you, or you've learned from Todd, or is this synergistic relationship? What is it? I mean, it's amazing. Like I said at the beginning of this, every time I talk to you, I learn something. I just feel, I don't know, I feel energized. It's like, I can conquer the world. I can go do this. Kim does it, and I can go do it too.
Yeah. It is absolutely me learning from Todd. So you mentioned the 8 books on Amazon. Those books would be fabulous stories and have no meat if I didn't have Todd Langford and his Truth Concepts calculators to prove what it is that I'm saying. You know Vince Dodona, right?
Yes.
He said it really well at an event. In fact, you might have even been at that event. He said, Kim is a master of the narrative and Todd is a master of the financial calculator tool. And so, yes, we do make a wicked good combination, but it is his teaching me that has given me not only the confidence, which of course comes through in my voice, but the ability. And because I have the ability to numerically prove absolutely everything that I'm talking about, I don't have to go numerically prove everything that I'm talking about every single time. It's like the example with this 4 generations, right? I did the research because I like to do it about once or twice a year just to kind of make sure that I'm still accurate about it. But I didn't need to do that research. I knew exactly what those numbers were going to come up to. And that's only because of a wicked amount of time sitting in the classroom with Todd Langford or his predecessor, Norman Baker, at the front of the room.
Yeah, you're the one that runs the computer that is demonstrating on the screen what Todd is saying and discussing. That's interesting that you say that, even though you're at almost every event that he has, and he does 2 or 3 a year, and there are 2 or 3 days each, and you're running through that and you're still learning. That's interesting.
Oh yeah.
I love that. So man, I wish we had another hour to talk, Kim. And maybe we'll have to come back. It just is really good. I mean, it's so fundamental and foundational. It's about everything that, and maybe this is too hyperbole, foundation and fundamental to everything that's American, right?
I agree.
Our country's prosperity is dependent upon us as individuals, right? And us individuals have to have complete, accurate information. And then when we have that, then every single person, man, woman, and child, has human life value and whole life, if possible. If not, you have human life plus term, right? And so, man, any parting words other than I don't know what you'd say to be better than what you've said. But
well, to pick up on what you said, Todd and I created the prosperity economics movement to bring America back to solid ground. That is our mission. And we know how to do that. You know how to do that. And so it is a joy to be able to provide. ProsperityEconomics.org is the website. There's a lot of learning that can occur there. My son's podcast, Wealth Renegade, is on that website. So you can have some fun with that, Scott. In particular, you'll be interested in listening to Robbie, I believe. And it's so fun to be able to do the work that we do in not only all of America, but also Canada. All of Todd's calculators are used by Canadians as well, with their long, long list of provinces and all the appropriate tax that is in there. And I'm just so grateful. I love talking about it. I would be more than happy to do a second version at some point if you want to grab a spot on the calendar. Podcasts are one of my favorite things to do.
Wow. Thank you. Scott, what do you think? Take us away.
I think that was great. First, thank you so much for coming on, Kim. We've had a blast talking to you. I always learn something new when we discuss this subject. And for all our listeners, know that Jason and I do this. It is a core strategy to everything we do. And it's not like we do just a little. We literally do as much as we can possibly handle at any one point in time. So I'd highly encourage it. If you want to learn more, we'll put links in the show notes down below. I would highly encourage talking to Jason. We gave him a hard time, although that's where a majority of my learning has come from on this subject. So thanks again, Kim. Jason, do you have anything you want to say, or?
No, I back up what you say. I have never asked anybody to do something that I or maybe a member of my family or close friend hasn't done with this. I live, breathe, sleep, all of this. To add what Scott said, there's been planning and preparation for this baby coming up December, as far as like we know how much of the human life value is dependent on a baby's human life value is dependent upon what the value of that's in place with the parents.
That's right.
And so we have made moves in the last 12 months strategically,
24 hours even,
and aggressively. In fact, a new whole life policy on his wife is, I don't know if it's in place. I know it's in place. However, I don't know if the first premium's been done. Have you done that yet today?
No, I need to call. I was planning on calling here in an hour.
The premium's ready to go, right? Everything else, the paperwork signed and everything. So everyone, this is for real, okay? It's not theoretical. What Kim was said at the very beginning, the thing that bugged her, she could see things, assumptions and everything that were being made in the financial planning, certified financial planning world that didn't mesh with reality. I'm telling you that what we do here is not theoretical. It is reality, and we're using it. And Kim does the same thing. And there's a whole community out there. If you look at that prosperityEconomics.org, there's a lot of people, and it's coming more and more and more. So it'll be, I don't know, pretty soon it'll be the trendy thing. Hopefully, I don't know. We'll see. Anyway, back to you,
Part
Scott.
of our goals.
Well, guys, thanks for tuning in today. If you'd like to connect with Jason or I or Kim, we'll put all of the links and contact information in the show notes down below. If you like the show, please make sure to subscribe. It really helps us out with the algorithms. And last, remember that mastering your millions all starts with your mind and your team. Make sure they are the best. Catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.